Good morning and welcome to the Winter 2025 Economic Forum of the National Institute of Economic and Social Research. I'm Adrian Pabst. I'm NISA's Deputy Director for Public Policy, and it's my great pleasure to welcome all of you here today for the presentation of our global economic outlook and our UK economic outlook. In a moment, we will hear from three of my colleagues. I just want to start with some very brief opening instructions and then some equally brief opening remarks. So all of our participants here for this webinar today are in listen only mode. And that means if you want to submit a question, please do so via the chat function. And when we come to the question and answer session after the three presentations, we will then read out your name and we will give you the option of asking your question live. So that means we will unmute you at that point. If you have a microphone, do please ask your question to our presenters directly. If you don't have a microphone, that's fine. I can read out your questions, so just let us know. A full recording of this webinar will also be available on our website and indeed on various other channels such as YouTube. So to our forum this morning. We live in a radically uncertain world with new announcements about tariffs coming almost daily from the new US administration and President Trump. And of course, domestically, there are a lot of headwinds as well in terms of where growth and inflation are going. We at NISA have been arguing for a long time that a key role of policy is to absorb shocks and to try and reduce uncertainty, which is why we have called consistently for a wholly different fiscal framework that doesn't just emphasize this or that particular target, because these targets are arbitrary, but rather looks at the fundamental objectives. What are we trying to achieve with fiscal policy? What are the things that we want to see happening? Higher sustained and indeed sustainable growth, job creation, productivity increases in all parts of the United Kingdom, not just in the already prosperous and productive parts, and so on and so forth. It's really working back from objectives to instruments. That is the key move. And we will hear more about this from our presenters this morning. As I said, there's a very intense and fast-moving international context, which is why we will start with the outlook for the global economy, which my colleague Patricia Sanchez-Juanino will present. She will be followed by Fergus Jimenez England, who's going to present our outlook for the UK economy. And then finally, my colleague Arnab Bhattacharjee will present the outlook for the UK regions and households. After the three presentations, we will take questions. So do please put them in the chat. We'll call your name and you can then put those questions to our presenters directly. So let me hand over to Patricia for our outlook for the global economy for winter 2025. Patricia, over to you.
Thanks so much, Adrian, and good morning, everyone. Thanks for joining us today, this morning. As Adrian had just said in the introduction, I'm just going to talk to you about our latest forecast for the global outlook. This forecast is the result of our hard work for all the people that is named here in the slides, which I may give thanks. It's always a pleasure to work with this team. And the tool that we use to produce the forecast is our NIGEM. NIGEM stands as the National Institute Global Econometric Model. It's a multi-country model that is mainly used by us and by our subscribers worldwide to do a scenario analysis and for economic forecasting. I'm going to show you some examples of this scenario analysis that we have done for the outlook and also the forecast. But we do other types of scenario analysis like climate related, for example. So if you are interested in any kind of, in this kind of analysis, please let us know, contact us after the presentation, and we'll be more than happy to assist you. Okay, so saying that, here you have the key messages from our outlook. The first thing I want you to focus is on the global GDP growth. And I have to confess that our global GDP growth haven't changed much since our November forecast, as it runs ahead 3% every year in the medium term. So we haven't changed this forecast, but this outcome is subject to the policy uncertainty that we have been seeing and we have been living in the few months. This mainly relates to the tariff imposed by the US, the tariff that were announced and now they are already imposed. So that have created this policy uncertainty in the outlook. In terms of the inflation, we've seen that the headline inflation of some advanced economies has lower. However, the uncertainties around the tariff has increased the inflation expectations. This leads us to think that the like the central banks of the advanced economies will ease their policy interest rates, but there will be some divergence. We see the European Central Bank, the ECB, to remain a bit dovish as the European growth is still struggling. And we see the Fed a bit cautious and watchful of the inflationary impacts that the tariff may have. Related to this, we have seen the bond yields, the long-term government bond yields, quite volatile and rising. And that has bring us some concern from the fiscal sustainability of the advanced economies. Let's talk about this with some figures. We start with the first chart. Here you have the policy uncertainty index. This is a text-based index, and in the chart you can see in the black line is the trade policy uncertainty index. And as you can see, since November 24, when the US President Donald Trump was elected, it has reached to levels similar to COVID, even higher levels. And this is the same with the red line, that is a more broad index that also capture other policies that the President Trump has announced related to migration or climate policies. So what does mean to our forecast? If we move to the next slide, we can see that our central case scenario has remained similar to what we have, but the confidence bands that this forecast can lay out has widened. So now our GDP forecast for the global is in 2025 is 3.2%, but there is now higher probability that it could range between 2.5 and 4%. You can see that in the chart in the left-hand side. And in terms of the inflation, in this case, in the chart on the right-hand side, you can see the OECD inflation rate doesn't include Turkey. And now our forecast for the OECD inflation stands, please go back. Now the forecast inflation stands at 2.3% this year, but you can see the probability range can be between 1 and 3.5%. So if we move to the next slide, here we can disentangle a bit what is hidden in the global figure. I was saying to you that global GDP was 3%. But this figure is hidden, that there is a divergence between advanced and emerging economies, but also within the regions. We've seen the advanced economies struggling for the food prices, energy prices, and also as a result of the responses to the monetary policy. And they have struggling more than the advanced economies. Given that, we forecast advanced economies to grow at 1.8% in 2025. And this growth is mainly driven by the US, to which we forecast at 2.4%. On the other hand, the euro area is been underperformed, and we forecast the euro area 1.1% of growth in 2025. But as we move through the year, we could see a recovery on the region. In terms of the emerging economies, we forecast a 4%, with China and India being the lead of the growth. But we still see in the medium term prospect of China to be moderate to slowing in the coming years. as I was told you before, we use our NIGEN model for the forecast, but the other use of our model is to perform scenarios. So in our central forecast base, we haven't included any tariff because when we were developing the forecast, there were not any announcements or any certain policies imposed. So what we used for analyze this kind of impacts is our scenarios. So here you see the impact of a what if scenario that we run. And in this case, what we ran was a 25% tariff on Canada, Mexico, and 10% on China. All of them retaliate, but this is just on goods, not on services, and this is just on non-commodity goods. There is an option in our model to modify these scenarios, and you can play with these assumptions that we took because we thought that we wanted to show the best case scenario. That was what it was kind of announced at the end of the last month. So in the case that these tariffs are imposed, the US GDP growth may fall like 0.4 percentage points, and the inflation will rise by 1 percentage points compared to our baseline. So that's the impact of this scenario. But in our previous outlook, some of my colleagues, they ran similar scenario where it was like a full impact. We were impacting tariffs in all goods and services of 10% in all the countries and 60% in China. That impact could have led at 2% in the global GDP. So this is an example of how you can also use our model and how great tool it is in this case where new policies are coming in every day. So we move to the next. We talk a bit about the monetary policy and we focus on the interest rate. Given all these uncertainties, we expect the central banks of the advanced economies to continue easing their interest rate, but being cautious of the inflationary pressures of the tariffs. We expect 4 cuts for the European Central Bank, including the ones already happening in January, and 3 cuts for the Fed in this year. In the case of the Bank of Japan, we expect a gradual rise given the inflationary pressures that they are seeing, and for the Popular Bank of China to remain cautious with the tariffs as well. If we move to the next slide, we're going to have a look on the fiscal policy. We've seen, and you can see here in the chart in the left-hand side, that the long-term government bond yields have been quite volatile last year due to the inflation expectations and the risk premium that was rising last year. So that had led high deficits in the economies. So we saw during COVID-19 most of the advanced economies accommodating the fiscal policies, and we now expect them to go back to consolidation. That will have an impact on households, and that will have an impact on the short-term economies. So we've seen that already in France with the new budgets proposals that have had some kind of political issues there. And we, in our outlook, have performed a box, another scenario analysis, where we analyze the impact of that budgetary proposed. And you can see the results there in the chart at the left-hand side is the impact on the France GDP of this budget that also was done in our scenario. And you can see that France, the main impact for the France GDP will be the cuts in the government consumption that will lead to the 0.15 percentage points decrease compared to our baseline. And if we go to the last slide, here you have a summary of our forecast that you can go back to it after we finish. And now just that hands over to my colleague Fergus to talk about the UK economy.
Good morning, everyone. Thanks, Patricia, for an excellent presentation on the global economy. I'm Fergus. I'm an associate economist here at NISA, and I will be discussing our latest forecast for the UK macroeconomy. As usual, the UK outlook was a team effort, and I'm grateful to my colleagues for their hard work on this. So before I talk us through the key messages on screen, I think it's worth giving a brief outline of the state we're in. The newly elected Labour government delivered its first budget last October, pledging to boost growth for the UK. Since then, we've seen a pretty lackluster UK economy, albeit with some better than expected, though still underwhelming, GDP growth figures coming out yesterday. It's worth noting that the £70 billion of additional annual government spending announced in the budget has not yet come into effect, but we can't ignore that the sentiments of businesses and consumers are subdued. The key question for the Chancellor this year is whether the government's spending plans can restore growth to the UK economy and whether the budget did more than merely rearrange the furniture. So the key messages for our outlook are this year we expect GDP growth of 1.5%, driven by government spending and also export growth coming from sterling depreciation. We expect that inflation will reach 3.2% in January, averaging at 2.4% over the course of the year. We see inflation returning to target on a lasting basis from 2026. We forecast only two 25 basis point cuts from the bank this year. Given last week's cut, this means that there is only one cut remaining for this year. And last, we think that the government is on track to meet its new fiscal rules. However, there is no headroom remaining. So, growth for this year. Before we discuss the headline figure, I think it's worth quickly explaining the fan chart. The confidence intervals illustrated in figure 1.2 are based on the past distributions of the errors in our forecasting model equations. And we also have that the fans are symmetric, as we have not adjusted them to account for skews and risks. NISA is of the view that known risks are better articulated through scenario analysis. And as for radically unknown risks, we can only deal with them ex post. Okay, so now that is out of the way, figure 1.2 shows our forecast for annual GDP growth at a quarterly frequency. We forecast that GDP growth will be 1.5% this year. This marks a 0.3 percentage point upward revision relative to our pre-budget forecast. Growth this year will be driven by government spending, though we expect government activity to partially crowd out private sector activity. As these crowding out effects subside, we identify business investment as a driver of growth beyond the third year of the forecast. And we also think that there are downsides to the outlook for UK growth coming from tariffs. Moving on to inflation, we think that inflation will reach 2.8% in the first quarter of this year and average 2.4% over the whole year. We forecast that inflation will remain at the Bank of England's 2% target as of next year. We see upward pressure on prices this year coming from hikes in national insurance contributions for employers, as well as rising in the national living wage. Will also add some upward pressure on prices. And we think that there are upside risks to inflation coming from domestic wage inflation, global trade uncertainty, and in the short term, resource competition between public and private sectors. Moving on to monetary policy, we think that the bank will cut the policy rate by 25 basis points twice in 2025 and once at the start of next year. This means that we only expect one more rate cut this year. We think that loose fiscal policy, strong wage growth, fragile inflation expectations, and global trade uncertainty will make the bank exercise caution throughout the year. As shown in figure 1.8, we also judge that interest rates will settle at around 4%. This marks an upward revision to R star relative to our previous forecast. For those who don't know, R star is an unobserved phenomenon which kind of articulates the inflation neutral interest rate in the economy. And at NISA, we see a couple of new upward pressures on our star since our last forecast. For one, we have revised trend productivity upwards. This is owing to increased public investment from budget announcements, as well as capital deepening over the forecast. Also, since our last forecast, the budget announcements themselves point to a 4.4 percentage point upward revision in government spending, which is, a non-trivial increase. And as a small open economy that the UK is, it must be said that our star more generally will be strongly influenced by global developments. And since our last forecast, we've seen distinct developments in global trade fragmentation in the form of tariffs and potential policies surrounding that. And so we judge each of these developments to have pushed our star upwards. So moving on to the labor market, we forecast strong wage growth, upwards of 4% for both this year and next. Figure 1.7 shows that this implies positive real wage growth over the forecast horizon. And with strong nominal wage growth and well-behaved inflation, we expect household disposable incomes to grow by 1.9% this year on aggregate. We expect unemployment to rise in the medium run, reaching 4.5% by the end of 2026, before falling again towards the end of the forecast period. Upward pressure on unemployment comes from the hike in national insurance contributions for employers, and a more general subdued sentiment around business activity this year. However, much of this upward pressure on unemployment will be mediated, we think, by labour demand coming from public sector activity. So moving on to fiscal policy. In the autumn budget, the government announced two new self-imposed fiscal rules. The first of which is the so-called stability rule, which requires day-to-day government spending to be balanced by the end of the parliamentary term. We forecast that the government is just about on track to meet this stability rule, as growth in tax receipts drive a reduction in the current budget deficit. We think that the government has no fiscal room left, however. This means that the Chancellor has no fiscal buffer should there be any materialization of negative cyclical shocks between now and the end of the parliamentary term. I think that more generally, it's worth saying that NISA has been a leader in the discussion on the extent to which these arbitrary and increasingly complex set of pass or fail fiscal rules adequately evaluate fiscal sustainability. And while we forecast that the Chancellor just meets her fiscal rules, I think that it is also worth stepping back and asking whether this really changes the state of public finances in terms of sustainability, even though she is just about meeting her fiscal rules. Moving on to some more fiscal policy, the second of the Chancellor's self-imposed fiscal rules is the so-called investment rule, which requires that public sector net financial liabilities as a share of GDP is falling by the end of the parliamentary term. And we forecast that the government will also meet this fiscal rule, helped by strong GDP growth and deflator effects, bringing down the real value of financial liabilities. So to recap, this year we expect GDP growth of 1.5%, driven by government spending predominantly. We think that inflation will be above target this year at 2.4%, but return to target from 2026. We forecast only two 25 basis point rate cuts from the Bank of England this year, owing to loose fiscal policy, strong wage growth, fragile inflation expectations, and global trade uncertainty. And we think that the government is just about on track to meet its new fiscal rules. However, since there is no headroom remaining, the Chancellor is left with very little breathing room should adverse cyclical shocks hit the economy. And with that, I will hand it over to Arnab, who will be talking about the regional dimension of the UK economy.
Thank you. to my panelists, first of all, Adrian, Patricia, Fergus, and to all of you who have come today to join our analysis of the global and UK economy. In particular, I'm going to talk about the distributional aspects of this, so UK households, developed nations, and English regions. As ever, this is wonderful joint work, collaborative work across a range of colleagues and other partners across the country, including several universities who collaborate with us on our work. So thanks to all of them. We are immensely grateful. Without them, we wouldn't be able to go beneath the numbers at a subnational level. Thank you. Right, so the key messages that we have are not surprising. Slow and uneven recovery of household living standards. We'll be dissecting this a bit more from a sectional view a bit later. Entrenched gaps in housing and transport. Now, of course, housing and transport are two areas which have been signaled by the current government and Westminster as being policy priorities. So we are placing some emphasis on this to try and see how we can contribute to the policy debate relating to how much investments, where these investments are necessary, and how to bring about appropriate public investment together with crowding in private investment. And that then leads us to some main policy priorities. Now, to start with, the broader question or the backdrop to all of this is that real personal disposable income is projected to grow about 2% in slightly less than 2% in 2025 and 1% in 2026. While that is good news on average or on aggregate, this will not compensate for the falling living standards, particularly the way we do it as measured by equalized household real disposable income on the household below average income basis between 2022 and 2024. In particular, the bigger brunt of this shock will be is being borne by households in the bottom 20% of the income distribution. And for them, living standards based on fairly low rates of growth will not return to 21-22 levels before 2027. Having said that, there are some steps that this government and the previous government have been taking which can be beneficial or which has provided a little bit of welcome support for households at the bottom of the income distribution. In particular, in this outlook, we analyze the impact of progressive rises in the national minimum wage and the national living wage upon households. Now, what we find is that in aggregate, the impact of this is very small, and it is heterogeneous across the distribution. In particular, where it affects households are in the second decile of the income distribution, not the bottom decile, bottom fifth, the second part of the bottom fifth. Those are the households which are mostly affected by this. So in terms of household finances, first of all, we find that, this is still on the previous slide. In terms of household finances, in income, from the bottom decile, bottom 10th of the population, there are some advantages coming from minimum wage increases, but that is largely offset by lower benefit payments. So there is almost no effect there. However, there is an effect on consumption coming largely out of expectations of higher incomes in the future. In the second decile, on the other hand, we find that incomes rise quite a bit. So around 2,400 on average across households in the second tenth of the population. But consumption is largely flat. Now, the interesting question about this, or one interesting question about this is, how does this pan out in the employment space. In particular, how do the balance between income and substitution effects work? And so for that, we look at the impacts on unemployment and labor market participation, particularly against the backdrop also of falling labor market participation across the whole of the country. And in the bottom decile, we find no effect. This is of progressive rises to national living wage and national minimum wage since 2023. But in the second decile, both participation rises and unemployment falls as well, as a result relative to the counterfactual of no rise in the national living wage and national minimum wage. Now, why does this happen? This is because this rise encourages some workers to accept wage offers quicker and reduces frictional unemployment, together with engendering greater efforts to find a job. So we see a win-win here and a little bit of a welcome boost for households, particularly in the second decile of the income distribution. Moving on to the national insurance contributions, and of course, Fergus has talked quite a bit about this, and this is an important issue. So what we wanted to also see is where does it affect firms most? And this is also taking our household analysis now towards looking at heterogeneity across firms, and that is a work that we are progressively continuing to do at the National Institute. And what we do here on this chart is show the ratio of trading profits or surplus to wages or employees' compensation across the different broad government office regions of the United Kingdom. And where we find the biggest effects are in the Northeast, not a huge surprise. In the Midlands, again, not a huge surprise, and in Wales. Now, that gives us some sense of where firms, particularly smaller firms, SMEs, and so on and so forth, might struggle to actually meet the higher NIC contributions which were raised in the previous budget. Now, how does this pan out across industries or across sectors? Well, here we see the usual suspects at the bottom of the chart here. So the education sector, health and social work, real estate, transportation, storage, hospitality, and entertainment. Now, these are sectors which need, in some ways, potentially be supported by the government to meet the costs of higher NIC increases on businesses. Moving on, what we have also done is looking at where public investment might be best placed. Now, the government has already indicated that it is going to place some emphasis on housing and on transport. And all of you are keen observers of the National Institute, so you would know that we are undertaking a huge, pretty large project funded by the Nuffield Foundation to try and understand progress across various dimensions of social, economic, and political well-being or welfare in the country. And there, in what we have published a dashboard in September and some indices. What we have largely looked at is the period since the beginning of the pandemic to up to about 2023. Now, here what we are doing is we are taking specific aspects of that and trying to drill down further. For housing access, what we have done is we have gone back into the past to try and look at long-term trends across different parts of the country. And here you can see on these charts, plotted here for the 3 devolved nations for England and for London. So London being the red line here, and the 3 devolved nations are included here. What do we see? We see a secular decline in housing access since the global financial crisis. But the pace of recovery subsequently have been very varied. In particular, it has been somewhat more robust in Scotland relative to the other devolved nations and relative to England. But also the important feature here is London. In London, housing access has been hugely volatile, and that is again not a huge surprise. And London is a very heterogeneous region of the country in itself. So this unique dynamics and volatility is largely driven by high property prices and foreign investments in housing assets in London. Likewise, in public transport, what we have done is we have drilled down further into greater levels of spatial detail to come round first to ITL2 regions, the city regions of the United Kingdom, and further down to the local authority regions. And what we have done with transport connectivity is, so this is included in a box in the current outlook, box C. What we have done there in association with the National Infrastructure, this work is in association with the National Infrastructure Commission, is a look at both intra-region connectivity and inter-region connectivity, transport connectivity. And we find huge regional disparities persisting, and with public transport largely lagging behind private car travel. And particularly in urban centers in the south of England, there are the dual challenges of poor public transport connectivity, public transport in particular, and high congestion. So it takes more time for people to go into the town centers or the CBDs from their residences. Whereas rural areas struggle with inadequate public. These are important concerns, we think, for the government as it thinks about infrastructure in transport. So this then requires place-based policy interventions. We think that this requires greater devolution of transport budgets, which might come with the further developments in the devolution activities of the government, and creating seamless connections between transport modes, different modes of transport. And potentially by giving more authority, local authorities more control over transport networks, but not only more control, it also needs more resources to go with it. They can develop solutions tailored to regional needs. An important point here also is transition and fair transition to net zero. So addressing congestion and environmental concerns is essential for long-term sustainability, competitiveness, and higher productivity, and this needs to be carefully thought through. So moving on now to concluding thoughts and policy prescriptions, we think that changes in tax fiscal framework are required. Further changes are required to fund public services and boost public investment, and generally improve welfare across the country and growth, local growth. So specific policy actions that we suggest should reflect local and regional needs in central house building targets, as mentioned, aligning new housing with transport connectivity. The two are connected. In fact, all the different aspects of well-being are connected. And balancing investment in London and the Southeast with lifting up behind areas. Now, this is a bit tricky because what the government also needs to do is crowd in private investments together with public investments. But one needs to carefully think about where and what kind of investments one needs to go in order to provide greater externalities, benefits through externalities across the whole of the country, at the same time give incentives for the private sector to bring in investments. And with that, I conclude. Thank you.
Well, thank you, Patricia, Fergus, and Anna, very, very much for those three very rich presentations. We're now going to have about 20 minutes for questions. We've already had some in the chat, so as we will proceed in the way I mentioned at the beginning, that is, we're going to unmute you and you can ask your question directly to our presenters. The first person who's going to ask a couple of questions is Ying Jin. So we're going to unmute Ying Jin. And Ying Jin, please do put your question. I think you have one for Patricia, which may be in two parts. And then I think you also have a question for Arnab. So can we unmute Ying Jin, please? Thank you.
Thank you so much, Adrian, and very kind of you. Thank you. And Patricia, basically, could you comment on the foreseeable investment trends in terms of, for example, trends in the main world regions, how they're going to change? And secondly, whether there's any overall slowdown in the trade as the trade wars are raging in terms of investment. And yeah, so would you like to comment on that before I ask the question for Anna?
Yeah, sure. Yeah, we've seen that there's been a slowdown on the investment activities in most of the advanced economies over the last couple of years, and we expect that trend to continue for a few years. And there are both like conjunctural and structural reasons behind that. That could be like some thoughts about that could be the higher interest rates that we've seen, and with the higher inflation that we have had, and we also think on that the R-star, this real rate of natural interest rates, that will remain higher because of the aging population or the high public debt, and that will also definitely constrain business investment. On top of that, all the geopolitical issues that are still, the Middle East conflicts, the Russia and Ukraine, that affect the global supply chains and contribute to the trade fragmentation. I haven't mentioned in my slides, but we have in our Outlook another box that looks through like global fragmentation and global trade fragmentation and what is the extent of that. So that there you can have a bit of more information. And other thing I wanted to mention is that there is a clear shift as well in the global demand from manufacturing to services. So we see that we tend to buy more services than long-term like durable goods. So that could also reduce the investment. And in terms of the regions, I will say that we have seen some gaining traction on the in terms of Europe for more like sustainable and digital investments. Like, well, for example, in the US, the AI investment, we may probably track more traction there. And yeah, and in terms of the trade war and the tariffs, any kind of protectionism that is applied will increase any constraints to all the already environment that we have. So there will be further constraint if more tariff are imposed. Yeah, I don't know if yeah.
Thank you very much. That's very helpful. And for Anna, really good talk, Anna, and very interested, particularly in terms of public transport activity differences between the regions. But at the beginning, you have a slide which you comment on that living standards are going to fall overall. So, but the real disposable incomes seems to be rising. So could you comment more on that?
Yes, Ying, a brilliant question. So, and this requires a little bit of unpacking. And so, okay, so 2 or 3 things. One is that if you look at real personal disposable incomes at the aggregate level, obviously that hides a lot of things. It hides a lot of distributional aspects. Now, part of this is, of course, recognized by the ONS, because of which they look at, in a distributional sense, they look at the equalized real household disposable income on a households below average income basis, on an HPAI basis. So what this does is 2 things. One is it adjusts household incomes by differentiating the household by household composition. How many people, how many adults, how many children are in the household. That's one thing that it does. Secondly, it does this calculation after household costs, or after housing costs. It takes out housing costs, and that is a better way to look at the distributional impact. So that is one thing which is going on here. So once you look at that, you find substantial shortfalls in living standards. Secondly, in particular, when you do this, you find that at the bottom end of the distribution, there have been very substantial falls, particularly since the cost of living crisis. when people really struggle to, in fact, many people, households needed to make the adverse, very perverse choice between eating and heating. So, this is really quite unprecedented. So there you find very, very sharp falls in living standards calculations. Secondly, or thirdly, actually, what this does is it takes into account the outgoings. It is not only about the how much households disposable income is, but how much it is relative to how much it needs to spend on necessities. And these are the calculations that go into our living standards. So living standards is a broader phrase incorporating not only household incomes adjusted for household composition and housing costs, but on top of that also the the fact that poorer households have a higher share or need a higher share of their income to be spent on necessities. Does that answer?
Yeah, thank you. So I look forward to working through the numbers actually to see the precise effect. It seems to be something, of the distributional effect which has affected this. Right. Thank you.
Well, thank you very much for those questions, Ying-Jin. And I should say that on living standards, we are launching a series of really, really interesting findings on the 13th of March, when we'll be presenting the results of a UKRI funded project on living standards. So there's much more to come in that space. And we will, of course, share details about that event and have some already on our website. So I look forward to seeing many of you at that. Now, the next question is by Keith. So could we unmute Keith? And yes, please, Keith, your question.
Thank you, Adrian. I hope you can hear me.
Yes, we can, Keith, and lovely to see you.
Great. Yeah, well, thank you, Adrian, and thank you to the team as well for the presentations. It's really useful, and all the work that went into that. Yeah, my question was really just picking up on the chart you had in the global section on the impact of tariffs on the US. And I wondered if you had a similar thing for the UK to gauge the impact of increases in tariffs or a trade war on the UK economy in terms of the impact on growth, and also any comments that it might have on inflation as well.
Thank you, Keith. Some really excellent questions there. I'm going to ask both Patricia and Fergus to comment on that, since that is very much at the intersection of the global and the UK outlook. So maybe first to Patricia and then to Fergus.
Yeah, thanks, Keith, for the question. Yeah, I mean, in our model, we have one of the key feature of the model that we can have the impact that all of the countries, but I just selected those countries because were with the biggest impact. But yeah, we have the numbers for the UK, and in the case of the 20% in Canada, China tariffs and 10% in the 20% for Canada, Mexico, and 10% to China, that in that scenario, we see a minus 0.1 percentage points of GDP compared to the baseline in terms of the GDP, and in terms of the inflation, an increase of 0.2 percentage points in inflation for the UK. But this is just to remind that this is our base case, and this estimate does not include any factor of the steel or aluminum tariffs, and also any reciprocal tariff that the President Donald Trump has been mentioning. So this was just the impact on the non-commodities goods. So if you put on top of that more tariffs, there will be much larger effects for sure.
Great, thanks, Patricia. Fergus, over to you.
Yeah, so just to expand on that, I have good news in that we do have graphs on this in the UK Outlook, figures 1.13 and 1.14, if you're interested. I should say, though, that naturally the magnitude of the effect of tariffs on the UK economy depends on the exact tariff bundle that is ultimately selected by President Trump and any retaliations thereafter. So actually, in our UK Outlook, since the tariff bundles were changing, we actually have figures for 25% tariffs on Mexico and Canada and 60% tariffs on China. But I think in saying these figures, it helps to give a range of kind of, I guess, the elasticity of UK growth and inflation with respect to these tariff bundles. So under this scenario, you'd have in the first year of tariffs, GDP growth could fall by 0.2 percentage points, with inflation rising by 0.4 percentage points. It's worth saying that this is obviously an intertemporal thing. So over the forecast period, which I think in the simulations was around 6 years, you'd actually find that inflation would increase on average by about no more than 0.5 percentage points, and GDP growth fall by no more than 0.02 percentage points on average over the 6 years. And again, this was with 60% tariffs on China, which is more than we are currently facing, but obviously more is yet to come.
Great. Keith, was that anything else that you wanted to ask?
Yeah, I mean that's very useful, and that's the impact of those tariffs. I mean, I guess that if there was a direct tariff increase on UK products and the UK retaliated, then those effects would probably be bigger, wouldn't they?
Fergus?
Yeah, I mean, I can only kind of intuit that you should expect perhaps that to happen. I guess it's a separate question as to whether the UK would retaliate. I think that given that it's a small open economy and it's currently in a slightly uncertain position insofar as its outlook for growth, I suspect that the UK would do well to not retaliate. But you know, ex ante, yes, you would expect worse effects for the UK if we were directly targeted. Yeah.
Okay, thank you. That's very helpful.
Great. Thanks so much, Keith. The next question is from Rory McQueen. So, Rory, please.
Hi. Thanks, everyone. Great presentation. Just a quick question on the UK forecast, Fergus. And I know you won't want to comment on the Bank of England forecast, but I noticed when yours was published, it looked a little bit more optimistic for this year than the bank in terms of UK GDP. But on closer inspection, I think that is all down to trade effects. And I just wondered whether you could comment at all on your forecast for trade, either separately, exports, imports, or jointly, and what's driving them.
Thanks.
Sure thing.
Great question. Fergus.
Yes. So I guess one of the great assets of our global econometric model is that we have a really quite comprehensive set of trade flows that we can really kind of flesh out some intuition from. So for us, it should first be stated that our outlook is better than the bank's latest judgment insofar as GDP growth is concerned. But it is worth noting from the outset that the downward revision was substantial. And so the first question that should really be asked is how the bank's information set has materially changed since last November. But that being said, as for the role of trade in our forecast, we're forecasting sterling depreciation over the forecast period. And you know, naturally that makes our exports internationally more competitive. But I also think that growth in exports this year will be bolstered by growth in import demand in the euro area. The global outlook is currently forecasting that euro area import volumes will grow by 4.4% in 2025. This is up from 0.2% growth in 2024. And the euro area accounts for around 42% of UK exports. At least that was the figure in 2023. And as so far as whether this year is an exceptional year for exports, it's exceptional insofar as the last 2 years have exhibited negative growth in exports. But yeah, a lot of the driving mechanisms behind the rosy outlook for exports this year will be coming from sterling depreciation and forecasted increase in import volumes from the EU.
Great. Thank you so much, Fergus. Thank you, Rory. I mean, it might just be worth mentioning as well that we, upgraded our forecast from about 1.2% of GDP growth to 1.5, really because at the time of our last outlook in November, we hadn't worked through the impact of the budget, since the budget was only published a few days before that, and we had already closed our forecast. And so that's really the fiscal stimulus in our budget that has led us to that view. And I suppose that's one of the differences with the bank as well. But let's move on to the next question, which is by Dimitri Korpakis. So can we unmute Dimitri, please? Thank you very much. Dimitri.
Thank you very much. A great presentation. I have a question to Patricia. And the question is if you expect that the American tariffs will have any positive effects on their internal industrial policy. That means, is there any hope that it will impact positively their internal manufacturing efforts? Thank you.
Thanks, Dimitri. I mean, very quickly, yeah. Maybe there will be some like short-term positive impacts in certain sectors, but what we have to realize is that there are any tariffs on commodities or raw materials, also even those sectors will be negatively affected, especially if like steel, like for example, if steels get expensive, all the manufacturing sectors that rely on steel will have higher costs. So there could be short-term positive impacts, but we see that in the long term there will be more negative outcomes.
Great. Thank you very, very much, Dimitri, for that great question. Thank you, Patricia. There aren't any more questions for now, so let me say a couple of things before we wrap up. One is, if you have any more questions, please don't hesitate to get in touch. We'd be delighted to answer questions by email, so do please get in touch with our external affairs team led by Neil. And they will, of course, get those questions to the presenters, and we'd be delighted to carry on the conversation beyond this webinar. The webinar, as I said, will also be available online. And the other thing I wanted to say is, if you've enjoyed today's event, and if you aren't already an individual or corporate member, can I just share with you some very, very brief details about our individual membership program, which has, we think, lots and lots of exciting benefits, access to the global economic outlook, including all the back catalog. And just to say that we, have had a lot of interest in our work on tariffs, which we first really focused on in November in anticipation of Donald Trump's re-election. And so there is really a lot of exciting material there, as of course Patricia has shared with us also this morning. You'd also have advanced access to the UK economic outlook, and I think Fergus's presentation shows just how much there is there to engage with in terms of growth and inflation and fiscal and monetary policy. You would get invitations to our Governor Seminar, where we have next up Baroness Nikki Morgan, former Education Secretary, but also in the past we've had John Pullinger, the chair of the Electoral Commission, Will Hutton, who's an author and columnist, Ed Conway from Sky News, Dame Colette Bowe, who's the past chair of the UK Banking Standards Board, and many, many other exciting speakers. So there would be that, and also advance notice of high-profile events. The next one is our Dow lecture on the 26th of February with the external member of the Monetary Policy Committee, Swati Dingwa, to which we're hugely looking forward. And you would also get our monthly newsletter. So lots and lots of benefits for the small sum of £150 a year. Do please come to us with any questions about that individual membership program. We'd be very happy to answer them, and also to tell you about more benefits. Thank you again, everyone, for attending this morning. Great questions. We really enjoyed the discussion with you. Keep in touch. And I also want to thank my colleagues, Patricia, Fergus, Anna, for their excellent presentations, as well as Neil's team for organizing this. So thank you very much, and have a great rest of Friday and a good weekend when it comes. Bye-bye.
Thank you. Thank you.